Right, let's review what's going on in the market. So first is which markets are active. So you have the euro seems quite active, and ES is all right. Forget the BTC and crude. So crude, ES, euro. So why that's important is because active markets have campaigns, and campaigns have trends. So that's why you never trade a dull market, because it's going to whipsaw all over the place. But active markets that have range and volume have a tendency to attract smart money and strong hands, and basically trend because they want to make money from their daily range and the available volume to buy and sell. So those markets are ripe for intraday campaigns. Anyway, so there weren't a lot of signals except for crude. You see it's active, and that was at 9 o'clock. So we'll review all the markets, but this one was crude 909. You had a selling wave at 909, a supply wave followed by a pullback right here. That was 21 minutes, and it made a one-leg swing. So that was the only one I saw that's being picked up. And the risk reward here is like 2 to 1. Anything else? Not really. Not that was detected, but so crude was detected. All right. So ATR. Whoa. Yeah, Mondays have pretty good range. So again, you need range. You need that movement. And Mondays are predominantly bullish. Near term. Thursdays seem to be predominantly bearish. All right. All right, so today's action, market drove down, went up, rallied. When it rallied for about 18 minutes. There was a breakout right here. There's a breakout bar above that high. And they didn't have excellent follow-through, which is always a concern. But it did break, and it did rally with the biggest price volume in 48 and 42 waves. So that's strong hands. These numbers are too high for it not to be, right? So then the next step is just to confirm with whatever market you want. And I use the index, which is right here. You see a very clear rally. But you can use the NASDAQ. You could even use other stocks, like individual stocks, just to see if they're also moving. Doesn't really matter, but the idea is to have some confirmation. All right. So you see here, index also breaks, has a rally, then pulls back. That's where the entry opportunity is available, and then has a rally which is matched, and finally has another rally which is matched. And here we have a problem. This rally does not match. So this is a bear divergence, meaning this rally is unconfirmed. This high is unconfirmed. There's a problem here. And like I said before, when you have this movement where you have a shortening of the thrust or an up thrust, but it's unconfirmed, that doesn't mean you just take a short. That means get ready for the opposite side to take control. And that's what happened. this is the selling. 1, 2, 3, 4, 5 red bars in a row. 1, 2, 3, 4, 5. So in this area, they sold because they're sick of going up. So they go down, right? So the divergence, the bear divergence by itself is meaningless. As a bull divergence, what you need is follow through for the divergence, which is a big, strong wave. You get your bear divergence here, which is unconfirmed because of it didn't make a high, and then you have a strong selling wave. That is the confirmation. Alright? So, and we see the selling pressure. Then it pulls back, and we have that lower high, lower low, lower low, lower high, lower low, lower low. Higher high, rally, rally, rally down, going to be a rally down. That way, everything's in sync. Now, the key to remember is we look at ES and then confirm. But what if the ES didn't make a higher high, but the INVIX did make a higher high? That just doesn't mean anything. I'm only looking to confirm the higher highs on the ES. I'm not looking to confirm higher highs on any other correlated market. Any other correlated market. I'm only, looking for this market. All right? So you can see this is an excellent tool to use to help with the confirmations. Folks use, many other tools. They can just use the NASDAQ here. They use mid caps here. There's small caps here. They use various individual stocks. What else? And then, also use momentum oscillators, because it's likely that here there's a momentum divergence as well. Right here, there should be some momentum divergence. Why? Because 1, 2, and then you have 1, 2, 3 red bars. Then one green bar, one red bar, and it barely, goes up. So momentum divergences usually have on the shortening of the thrust or springs and up thrusts. You see, there should be. If I was to bring up a momentum device, you would see that right here there would very likely be a divergence, and chances are right here there might be a divergence too. Why? Because of the shortening of the thrust. Momentum, typically you'll get the divergences when there's a shortening of the thrust or spring and up thrust that is shallow. Like here you have a very shallow spring, so that's momentum divergence because of it being shallow. And then what you do is you look for a follow-through confirmation. So that would be this wave here. How would you know? Just count the green bars and see if it's consecutive buying. 1, 2, 3, 4, 5, 6. 6 consecutive green bars without one red bar. Here 1, 2, 3, 4, 5 consecutive red bars. That's selling. This is buying. Even here, this is 1, 2, 3, 4, only one red bar and then back to green. This is also buying activity. Consecutive buying. I don't think that's talked about enough. When analyzing waves, one of the key things is consecutive green and consecutive red, buying or selling. This is consecutive selling, making a new low. Consecutive buying, making a new high. Not a new high, but a higher high. This here is consecutive selling, breaking these lows. See that? Red, 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 breaking lows. And you have to ask yourself, why does that happen? A lot of times that's a large order being executed. Anyway, the rest is all right. Let's just go over this. First, he made a lower day at 8:39, around 8:39, and then took about 9 minutes, right? 369. Went sideways a little bit, back to open in only 3 minutes. That would be this wave, this bar. And the wick took about 12 minutes. I think it took a little bit more than that, but because of the sideways movement, it didn't pick it up. It actually took 1, 2, 3, 4, 5, 6, 7, 8 or 9, about 27 minutes, which is, which is what I expect, because as the expected amount is about 24 minutes, this took 3, 6, 9, 12, 15, 18, 21, 24, 27, 30. It's about 30 minutes. I'm looking for around 24 or more, or a little more, a little less. So 30 minutes is fine. And actually, no. 3, 6, 9, 12, 15, 18, 21 minutes. Here's the count, because this is when it goes below the open. 3, 6, 9, 12, 15, 18, 21 minutes. And I was expecting 24. We ended about 8:54, and it was 31% of the range. That's important to know. Why? Because the markup is about 69 or 70%. So that's 1/3 risk to the high. And markup time took about 3 hours and 58 minutes. That is strange. Actually I do expect it to take around 4 hours. It took 2 hours and 9 minutes. Yeah, it took 2 hours and 9 minutes. That's a little bit less than I'm expecting. But around 3 hours, 58 minutes. It took 2 hours and 9 minutes. I'm expecting around 4 hours. So this markup was less than that. Now you have to ask yourself why. Why is it less than that? The answer is because we're in a fucking bear trend. Right? We're in a bear trend. And this rally is only 18 minutes. We're expecting 33 minutes, but it's only 18 minutes. And it's done at 9:09, so I'm expecting it to be done around 9:24. So it's close enough. It's just after 9. And then the pullback occurred at 9:15. I'm expecting 9:52. That's this pullback. It's pretty shallow. And it has only one pullback. The retracement spot on. Why? 50% retracement. I'm expecting about 60%, and as long as it's halfway back. Right? So that's really important. The risk here is about 925, right? And the reward was about 2,700. Not bad. It extended to the 1.9 extension. Almost, 1.9, almost double. And the duration it took to get there was about an hour and 36 minutes. And the high day was made at 10:51. Right? So what are some things to know? First of all, you have to be really careful of going long in a bearish market. Right? So if you do, just get ready. Look what happened here. It couldn't complete the markup of 4 hours. If it did, it would have gone higher. And we made the low of day at 8:30 and the high of day at 10:51. See? So the gap between the lower day and the high day is only 2 hours and 12 minutes. Usually it's double that, right? So that's one thing to note. Just to be careful, because as you can see, what did it result in? Long wick on the top side, which means that buyers pushed it up and it got rejected. Why? Because they're sellers all up here. On the top way, they're all sellers. Where are they? Right here. You see this? When it went up to 1051, red, 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 red. This is the selling that came up here and took the market back down. And the other thing to note is it's a good idea to always have a correlated market. Any correlated market, it just needs to be correlated. And that's it. Thanks. Bye.